Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Jeremy Baker, and Chaz Price. 419-794-3030 is the phone number. The website is arhq.com. The latest inflation number is at 3.1%, which is way down from the high in June of 2022, 9.1%. With that news, Wall Street is hoping that this year will be the year that interest rates start coming down. Here is former PIMCO chief economist Paul McCulley on CNBC.
The Fed is finished tightening. That's the big issue. The debate now is all about the timing and the magnitude of the easing cycle to come. And we'll be starting the new year, I think, with a warm and fuzzy tone, but not an urgent tone from the standpoint of cutting.
Now, if he's right, will this result in a decrease in some of the attractive rates that we've seen lately in CDs, money markets, treasuries, and annuities? Guys, can our listeners lock in the best rates if they take action now?
I really think now could be one of the best times to lock in fixed interest. Obviously, the Federal Reserve has come out and they've talked about their projections in the future. Most of the indication that they've given is they plan to not raise more rates. They plan on potentially looking to lower rates at some point in the future as these inflation numbers cool down. So this could be an optimal time to be able to lock in some of the rates that are out there. And I had a conversation with an older couple. They were in their 80s, and we had talked about various options for locking in interest. And there's probably not one wrong answer I told them on whatever they picked, because if we looked at what they were currently in, anything was better than what they were getting now. So, folks, if you have not upgraded your checking, savings, money market accounts, old fixed annuities, or you have lazy assets, really now can be one of the best times, again, in 20 years to be able to consider what your options are and be able to lock in rates. We did a complete segment kind of breaking down, the ways that you can get over 5% interest in this environment, everything from short-term liquid investments to longer-term locking in rates. But back to this couple that I was talking with, Chuck and Sally, we'll call them, and they're in their 80s, and they were talking a little bit about the fact of they didn't know how long it was going to be that they were going to continue to be here. I'm hoping they're here for a long, long time. And so we had gone through the short-term investments, and we had gone through the longer-term investments. In fact, you can lock in an interest right now at some of the insurance companies of America for 10 years. And, the initial thought process that they had is they said, you know what, I'm not going to be here 10 years. And I said, well, you may be surprised. I think I'm betting on one of the two of you being here for 10 years. But in the event, with an insurance contract, if you look at the fine print and understand how the product works, God forbid, like if the husband had purchased this 10-year contract, he's locked in for that 10% or locked in for that fixed rate interest for that 10 years for that time frame. Again, it was in that 5 to 6% range is what the interest was that he could lock it in. So if interest rates go down in the next 3 or 5 years, he's locked in at the higher rate. This is something that he could take a chunk of money and set it aside. Of course, you have to look at withdrawal features, surrender charges, and things like that. But, one of his concerns was, well, what if I passed away? If he passed away, this particular contract said his wife could do one of two things. She could either take it over, if, again, she being the primary beneficiary. She could assume his account. She'd continue to get paid that interest as a spousal assumption. Or she could cash it out and take that money and do something else with it. So again, there's no penalty upon death. So it is important to take a look at those, because on the surface, what they originally thought is, let's just put it in a money market account. And again, as I pointed out earlier, I don't think there's a wrong answer with anything. Anything was better than the interest that they were getting paid before. But the disadvantage of locking it in short term is that short term, when interest rates go down, they're going to get paid less interest whenever that investment rates go down in the future. So, you want to consider when you're going to need it, liquidity, features like that. But now, in my opinion, unless there's a shock to the system, which can happen, we see shocks to the system that happen, but unless there's a shock to the system, now may be one of the best times to lock in these high rates. What do you guys think?
I'm a little bit torn on it because I feel like the question is a little bit of a loaded one in the sense that you have to assume that you do one or the other. Like you either are in an equity or a bond, and I think for everybody should always have some component of their investment portfolio in something that's fixed. The main goal being a return of my money, not necessarily return on it. So whether that is a bond or a fixed annuity or cash or money market instrument, there certainly is some advantage to having this money that can't lose and that's going to be there for you, worst case scenario. That being said, I do think there's an opportunity, couple things with bonds right now going on. One, again, is the fact that we haven't seen a measurable rate like this in the last 15 years. I know on an earlier segment, Andrew was in, you're like, hey, bud, interest rates haven't been this high since you were born, so it's definitely something to take notice of. But in my head, the reason that interest rates have gone up so much is primarily because the fact that, or I should say they're actually on their way back down. Interest rates were artificially propped up there by the Federal Reserve, and now they're actually on their way down because for some of the same reasons that you're citing is that people are getting while the getting's good. My mom would always say that, get while the getting's good. If the interest rates are high, go ahead and lock it in. But from a contrarian perspective, as these interest rates start coming back down, and yes, you want to lock in a fixed interest rate while the getting's good, a lower interest rate is actually going to be better for the stock market. Generally speaking, lower interest rates like we experienced in the last decade have been an exceptional tailwind for the equities. And so, not so fast, my friend. As Lee Corso would say, don't rush and put all of your portfolio into bonds because a 5% interest rate, although it might seem attractive, when you look at it on a real basis, and even taking an after-tax perspective of it, your real rate of return with inflation is really closer to like 2. Stocks in equities have historically been a great inflation killer, especially dividends. And so I'm not so sure. I mean, yes, in one aspect, we always want to have some money in a fixed rate. If you haven't upgraded your fixed income, give us a call and we can help take a look to see what's available. Is it short? Is it long? But as these interest rates continue to come down now, as people are flocking to bonds, I wouldn't necessarily be looking at a bond. I'm actually would be more interested in what's the impact of an expected lower interest rate in the future going to do to the stock market, because we've seen this rip your face off rally that's occurred as a result of the 10-year Treasury going from 5 down to like under 4 right now. That's where I might be looking for the opportunity in addition to whatever I already have parked in my safe bucket.
Right. When you talk about different buckets, you mentioned the safe bucket. I think what I look at as far as, from an overall financial plan in our independent income system is knowing what your safe withdrawal rate is. And if you don't know what that is, give us a call. We can help you look at that number. But if that number is, let's just say for easy math, it's 3.5%. And if you can get 5% in a fixed rate, you're outpacing that number. So if it's again one of those situations where it shouldn't be all or none. Because I think the question was, is now the good time to lock in the fixed rates? The answer is probably. So I think if you take a look at that number, and in the case of somebody that's in their 80s, if they know that their safe withdrawal rates in the 3s and they can lock in 5 for the rest of their life or life expectancy, I think that might be a good way to go. But there's no really one answer for everybody. It's more of an individual thing.
Well, I'm going to tell you what the one answer is for everybody. The one answer is for everybody is if you haven't looked at fixed rates and how they apply to your individual situation, while rates are at the highest level of there, and I would agree there could be some good growth in equities, and I would agree, you don't put all your eggs in one basket, but now could be a phenomenal time, again, to be able to look at your situation and say, how do I apply this and what's the best use of this tool to achieve the outcome of what I want to accomplish, and then we can help you figure that out.
We've spoken many times here on the show about timing the market, the perils of trying to do so, how it's a fool's errand. On the other side of it, we seem to be at a tipping point when it comes to interest rates. They've held steady for the past couple months. All signs seem to indicate they're going to be lower in the future. Knowing what opportunities lie with the rates being as high as they are and with them going down in the future, how to take advantage of both of these things as it pertains to your plan. Well, that is where speaking with someone like the team at America's Retirement Headquarters really comes into play. Threats and opportunities, as they talk about so often. Figure out what the opportunities are right now, what the opportunities will be in the future with lower interest rates. It all starts with that phone call, 419-794-3030. And the website is arhq.com.